Preparing for an infrastructure finance interview? You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each one, you'll see what the interviewer is testing, the core concepts you should cover, and a sample answer. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What makes infrastructure finance different from traditional corporate finance? The interviewer wants to assess your understanding of infrastructure as an asset class, especially long-term contracted cash flows, high leverage capacity, public service characteristics, and project-level risk allocation. While answering, focus on stable cash flows, asset lives, regulation, concession agreements, non-recourse debt, lower operating volatility, and why lenders underwrite projects differently from ordinary corporate borrowers. Infrastructure finance is usually asset-based rather than company-based. I look at the cash flows of a road, airport, power plant, port, or utility asset and assess whether they can support long-term debt. Compared with corporate finance, leverage is often higher because revenues may be contracted, regulated, or availability-based. The key is risk allocation. Construction, demand, operating, regulatory, and refinancing risks must sit with parties best able to manage them. Question 2. How would you explain project finance in an infrastructure context? The interviewer is testing your understanding of non-recourse or limited recourse financing, special purpose vehicles, lender security packages, contractual cash flows, and sponsor risk separation. Make sure to cover the SPV structure, debt repayment from project cash flows, contractual framework, lender protections, security over assets, and the distinction between sponsor credit and project credit. Project finance funds a specific asset through a dedicated SPV, with debt repaid primarily from that project's cash flows. Lenders are not relying mainly on the sponsor's balance sheet. They focus on contracts, permits, cash waterfall, reserves, covenants, and security over project assets. For example, a solar project with a long-term power purchase agreement can raise debt based on contracted revenues, operating costs, tax assumptions, and downside production cases. Question 3. What are the key risks you would analyze before financing a greenfield infrastructure project? This question evaluates your ability to identify construction stage risks, completion uncertainty, permitting issues, cost overruns, delays, sponsor capability, and how these risks affect financing terms. In your answer, talk about construction risk, EPC contract quality, permits, environmental approvals, interface risk, funding certainty, contingency budgets, delay liquidated damages, and completion support from sponsors. For a greenfield project, I would start with construction risk because the asset is not yet generating cash. I would review the EPC contractor, fixed price protections, completion date guarantees, liquidated damages, contingency, permits, land rights, and environmental approvals. I would also test whether delays create liquidity pressure or covenant breaches. Lenders typically want stronger sponsor support, reserve accounts, conservative leverage, and sometimes completion guarantees until the project reaches commercial operation. Question 4. How do you calculate and interpret the debt service coverage ratio? The interviewer wants to assess your command of core credit metrics, cash flow available for debt service, scheduled principal and interest, lender downside protection, and debt sizing logic. Be sure to mention the DSCR formula, difference between projected and historical ratios, minimum versus average DSCR, sector benchmarks, and why lenders focus on downside cases. DSCR equals cash flow available for debt service divided by scheduled principal and interest. If a project generates $120 million of CFADS and owes $100 million of debt service, DSCR is 1.20x. A higher DSCR means more cash buffer for lenders. In infrastructure, lenders usually test base case, downside case, and sometimes lockup or default thresholds. The required DSCR depends on revenue risk, contract quality, asset type, and jurisdiction. Question 5. What is CFADS, and why is it so important in infrastructure debt sizing? The interviewer is testing your understanding of cash flow available for debt service, including operating cash generation, maintenance CapEx, taxes, working capital, and senior debt repayment capacity. While answering, focus on how CFADS is derived from revenue less operating costs, life cycle costs, taxes, working capital movements, and why it drives DSCR-based leverage capacity. CFADS is the cash flow available to pay senior debt service after operating expenses, taxes, working capital needs, and required maintenance or life cycle CapEx. It matters because lenders size debt against cash, not accounting earnings. Depreciation may reduce accounting profit, but it does not directly repay debt. In an infrastructure model, I use CFADS to calculate DSCR, sculpt amortization, test covenants, and estimate how much leverage the project can responsibly support. Question 6. How would you distinguish availability-based revenues from demand-based revenues? This question evaluates your understanding of infrastructure revenue models, especially the difference between contracted public sector payments and user volume exposure, and how each affects risk and leverage. Make sure to cover availability payments, performance deductions, traffic or volume risk, tariff exposure, revenue volatility, credit quality of the payer, and implications for debt sizing. Availability-based projects are paid for making an asset available at agreed performance standards, regardless of actual user demand. A government may pay a road operator if lanes are open and maintained. Demand-based projects depend on users, such as toll road traffic or airport passenger volumes. Availability revenues are typically more predictable, so they support higher leverage and tighter margins. Demand risk requires more conservative forecasts, stronger downside cases, and often lower debt capacity. Question 7. Walk me through a typical infrastructure project cash waterfall. The interviewer wants to assess your understanding of priority of payments, lender protections, reserve funding, restricted distributions, covenant controls, and how cash is allocated through the financing structure. In your answer, talk about revenue collection, operating expenses, taxes, senior debt service, reserve accounts, major maintenance funding, subordinated debt, distribution lockups, and equity distributions. A typical cash waterfall starts with project revenues flowing into controlled accounts. First, the project pays operating costs, taxes, and required maintenance. Then, it funds senior debt interest and principal, followed by reserve accounts such as DSRA or major maintenance reserve. If covenants are satisfied, remaining cash can pay subordinated debt or equity distributions. The waterfall protects lenders by ensuring essential project costs and senior debt service are paid before sponsors extract cash. Question 8. How would you size debt for an infrastructure asset? The interviewer is testing whether you understand multiple debt sizing constraints, including DSCR, loan life coverage ratio, gearing limits, tenor, amortization profile, and downside case resilience. Be sure to mention starting with forecast CFADS, applying minimum DSCR, checking LLCR and leverage limits, matching debt tenor to asset life, and running sensitivity scenarios. I would start with forecast CFADS and apply the minimum DSCR required by lenders. That gives an initial maximum debt service profile. Then I would sculpt principal repayments around cash flow seasonality and check LLCR, gearing, tenor, final maturity, reserve requirements, and downside cases. Debt capacity is not just the highest number a model produces. It must remain bankable under sensitivities for volume, price, inflation, OPEX, CapEx, and interest rates. Question 9. What is the purpose of a debt service reserve account? This question evaluates your understanding of liquidity support mechanisms, lender risk mitigation, temporary cash shortfalls, reserve sizing, funding methods, and credit enhancement in project finance. While answering, focus on DSRA purpose, typical sizing in months of debt service, cash versus letter of credit funding, replenishment requirements, and lender protection. A debt service reserve account is a liquidity buffer dedicated to paying debt service if project cash flows temporarily fall short. It is often sized at 6 months of scheduled principal and interest, though sizing varies by deal. The DSRA can be funded with cash, a letter of credit, or built up from project cash flows. If drawn, it usually must be replenished before distributions to equity resume, which gives lenders added protection. Question 10. How do concession agreements affect infrastructure financing? The interviewer wants to assess your understanding of contractual rights, concession term, termination compensation, performance obligations, tariff rules, handback requirements, and how these terms influence bankability. Make sure to cover concession length, revenue rights, operating standards, change in law protection, termination payments, handback conditions, step-in rights, and alignment with debt maturity. The concession agreement is central because it defines the project's right to build, operate, collect revenue, and transfer the asset. I would examine the concession term, tariff mechanism, performance obligations, termination compensation, change in law protections, and handback requirements. Lenders want the debt fully repaid before concession expiry, with enough tail period for refinancing or stress. Weak termination compensation or uncertain tariff rules can materially reduce leverage and investor appetite. Question 11. How would inflation affect an infrastructure investment? The interviewer is testing your ability to connect macro assumptions with revenues, operating costs, debt service, valuation, indexation mechanisms, and real versus nominal return analysis. In your answer, talk about CPI-linked tariffs, inflation pass-through, cost escalation, fixed rate versus floating rate debt, real cash flows, discount rates, and valuation sensitivity. Inflation can help or hurt depending on the asset's contract structure. If revenues are CPI-linked and operating costs are manageable, inflation can increase nominal cash flows and support value. But if costs rise faster than tariffs, margins compress. Debt also matters. Floating rate debt becomes more expensive when inflation drives rates higher. I would model both revenue indexation and cost escalation carefully, then assess whether returns are protected in real terms. Question 12. What is the difference between PPP and privatization? This question evaluates your grasp of public-private delivery models, asset ownership, risk transfer, government involvement, concession structures, and how financing responsibilities differ across frameworks. Be sure to mention that PPP usually involves long-term contractual delivery with public ownership or oversight, while privatization transfers ownership or control more permanently to private investors. A PPP is a contractual arrangement where the private sector finances, builds, operates, or maintains public infrastructure under a long-term agreement. The public authority usually retains oversight, and risk allocation is defined contractually. Privatization is broader and often involves transferring ownership or control of an asset or business to private investors. In financing terms, PPPs depend heavily on concession cash flows, government payments, and performance regimes, while privatizations may resemble corporate acquisitions. Question 13. How would you evaluate the equity return of an infrastructure deal? The interviewer wants to assess your understanding of sponsor economics, equity IRR, cash yield, exit value, leverage impact, downside protection, and risk-adjusted return requirements. While answering, focus on project cash flows after debt service, distributions, terminal value, entry price, leverage, holding period, downside cases, and comparison with target returns for the asset risk. I would evaluate equity returns using distributions after debt service plus exit proceeds, measured by equity IRR, multiple of invested capital, and cash yield. The required return depends on risk. Contracted brownfield utilities need lower returns than greenfield merchant assets. I would test leverage, refinancing assumptions, exit multiple, CapEx, and downside revenue scenarios. A strong base case IRR is not enough if returns disappear under modest traffic, tariff, or interest rate stress. Question 14. What sensitivities would you run on an infrastructure financial model? The interviewer is testing your practical modeling judgment, ability to identify key value drivers, lender downside scenarios, sponsor return sensitivities, and risks that could break covenants. Make sure to cover revenue volume, tariffs, availability deductions, OPEX, CapEx, inflation, interest rates, construction delay, refinancing margins, terminal value, DSCR, LLCR, and equity IRR. I would run sensitivities around the variables that drive credit and equity outcomes. For revenue, that means traffic, volumes, availability deductions, tariffs, and inflation indexation. For costs, I would stress OPEX, lifecycle CapEx, construction delays, and maintenance timing. On financing, I would test interest rates, margins, amortization, and refinancing assumptions. Then I would track DSCR, LLCR, distribution lockups, equity IRR, and whether the project still remains financeable. Question 15. If a toll road underperforms traffic forecasts by 20%, what would you analyze first? This question evaluates your scenario-based thinking, ability to diagnose revenue underperformance, distinguish temporary from structural issues, and connect operating results to debt service and valuation impact. In your answer, talk about traffic mix, tariff levels, economic conditions, competing routes, ramp-up assumptions, elasticity, covenant impact, liquidity, DSRA usage, and possible mitigation strategies. I would first determine whether the shortfall is temporary, seasonal, or structural. I would compare actual traffic by vehicle class against forecast. Check tariff elasticity, competing routes, macro conditions, and whether ramp-up assumptions were too optimistic. Then I would quantify the impact on revenue, CFADS, DSCR, covenant headroom, DSRA usage, and distributions. If the issue is persistent, I would review cost reductions, tariff strategy, refinancing options, and potential sponsor support. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.